Good morning from London. I'm Kriti Gupta alongside Lizzy Bird, and we're an hour away from the opening trade. Here's what you need to know. Risk assets beginning the week on a cautious note as trade tensions flare among the two largest economies, China and the United States, accusing each other of violating last month's trade deal. Meanwhile, oil taking a leg higher, bolstered by a smaller than expected OPEC plus output hike. And Ukraine stages a dramatic series of strikes across Russia as far away as eastern Siberia, while Moscow ramps up drone and missile attacks against Kyiv, escalating tensions ahead of crucial peace talks this week. And in Poland, the center does not hold. A nationalist candidate backed by Donald Trump wins the presidential election, defeating the centrist mayor of Warsaw in a blow to the country's pro-European Union government. Lizzy.
Very good morning, Kriti. Checking in on these markets this morning, and it's trade dominating the narrative yet again. All of this uncertainty around the US-China relationship, but also the first chance that traders have to factor in the doubled steel and aluminium tariffs. So futures lower on both sides of the Atlantic this morning. We have gold higher as traders flock to safety, and Brent still higher at $64 a barrel, up 2.4%, despite that OPEC plus production hike over the weekend because of those geopolitical concerns that you mentioned, Kriti, on Ukraine and Iran. The countdown to the opening trade starts right now.
Good Monday morning. Welcome to the opening trade. There's a lot going on in these markets when it comes to trade tensions, geopolitical developments. We've got one eye on Ukraine, one eye on the Middle East, of course, one eye on Poland as well. So to digest all of this, we thought we'd do something a little bit different today. We thought we'd bring in a guest host. Max Kettner, HSBC's chief multi-asset strategist, will be joining us throughout the hour, giving us his take on just kind of how we're dealing with all these various flows of news. Thank you for joining us.
Thanks for having me. Thank you.
Max, it's like the perfect day to have you today because your latest note is all about the defence of the taco trade, right? That the Trump policy put comes in. And Kriti, the whole agenda today, I think, Max, defeats your argument.
Go ahead, Max. Give us a quick second here. There's so much to digest. Let's set the news agenda for a moment. Let's start with the trade tensions here before we get Max's take on this, and we'll throw some soccer in there as well because I'm sure you watched a little bit of that over the weekend. Let's start with the trade story here. We've got the world's two largest economies basically saying you violated the trade deal. This was a story out of the States last week, China now having the same argument. And yet these markets aren't in panic mode just yet. And I think that's really fascinating, given the fact that we're not just talking about a trade truce being violated, Lizzy. We're talking about steel tariffs perhaps coming right back on. We're talking about geopolitical volatility. Where does this leave us in terms of that Geneva mechanism that we were so positive about?
Exactly. So your argument, Max, is that if you wait long enough, Trump will come to the rescue. He will change his mind. You will get the policy put. But look, so what we've had is, yes, the US-China trade truce, now that's breaking down. Then you have the tariff ruling. Trump comes back with doubled aluminium and steel tariffs. So my question to you is when you get a reckoning here.
Yeah, look, I think, and thanks for having me, right? So, look, I think it's slightly more nuanced. It's not just about, OK, we know he's going to fold, so whatever, I don't care about it anymore. But let's be honest, if we had had the news from Friday after close and over the weekend, if we had had that a month ago or a month and a half ago, I don't think we'd be down 30 points on the S&P future. We'd probably be down 100, 150 points. Right? So this is already kind of showing you that the sensitivity of investors and of traders towards those tariff news is probably going down a bit, because you're sort of realizing, OK, this is, in fact, really a negotiation tool. It doesn't mean that he's necessarily going to fold immediately, but it is primarily a negotiation tool. So it's not going to stick. I don't have to factor in something persistent, a persistent drag on earnings, a persistent drag on the earnings outlook, not just for the next 1 or 2 quarters, but on 12-month forward, on the next 2 years, right? I don't have to factor that in. That's the first thing. The second thing I would say is, and that comes to the taco trade, right, is that when we think about it, what we've learned in the last month and a half is that eventually this is a negotiation tool. Yeah. So eventually there is a put from this administration. There is a policy put. What we don't know is where's the strike price. We don't know when it's going to be exercised. We don't know the timing of it. But if you're an investor and you sit there right now and you're saying, right, I'm getting 50% additional tariffs on steel. So most likely I've already missed the time to sell. So most likely already equities are down 1% or 2%. So I'm late in selling. But I know there is going to be a put. I just don't know where the strike price is, and I don't know where the timing is. So most likely I'm going to be also late for buying. So I'm late for selling, I'm late for buying. What's my rational reaction? I'm not going to do anything. And that reduces, that's what we're seeing right now. That is why it reduces the sensitivity to those tariff news.
That complacency story is a fascinating one, Lizzy, because it does, I feel like the point that Max is making here is that the downside risk is so high that you freeze, basically. And I feel like we're now applying that to the trade truce. When we've seen that applied to geopolitical volatility, for example, and I think a great example is the sensitivity to perhaps the developments coming out of Ukraine and the war with Russia. And I think that's really crucial here because, say, 3 years ago, we had these massive sensitivities towards what was going on. We showed up in the oil prices, showed up in risk sentiment. This time over the weekend, we should talk about the developments we've heard in that part of the world. The most kind of aggressive strikes from both sides, from Moscow into Kyiv, and then, of course, Ukraine into the farthest parts of Russia, into eastern Siberia, just coming days after getting kind of the green light from Germany, as well as comes after the meeting last week with Vladimir Zelensky and Friedrich Merz in Berlin as well. This is some scary stuff.
It is scary stuff. I think what's really interesting is it comes on the day of the UK Strategic Defence Review. They're talking about plugging loads of money into heavy weaponry, right? But these are $200 drones, just taking apart this very expensive weaponry. What's the point in spending all that money, you might ask? And is the money that they're plugging enough to, for example, get the army numbers up so it's not a net loss? I mean, it just calls into question the whole of how other countries are approaching defence at this point.
Absolutely. I mean, again, we bring it back to the story because based on that narrative, we've had this massive push in the defense stocks. It's been the juiciest trade of the first quarter and continues to be one. But, Max, I'm curious where that factors in here. Should the investor sensitivity in terms of a potential risk dividend or lack thereof when it comes to the war in Ukraine be priced in?
Look, I think it is priced in somewhat, in fact. Number one, we're still seeing that because when we look at some of the reconstruction baskets, the Ukraine reconstruction baskets, they continue to trade pretty strongly. When we look at aerospace and defense in the stock 600, we're continuing to see that outperform, right? That aerospace and defense has outperformed the broader Eurozone equity market by around 32 percentage point. It's just added another 12 percentage points in May. So I would say it is being priced in. Perhaps you could argue that's a bit too much hope priced in. But when we talk about aerospace and defense, shouldn't we also be a bit honest and say, you know what, it doesn't actually, it doesn't matter to me too much what happens around Russia and Ukraine because we've not fulfilled that NATO target. Lots of European countries, in fact, almost all of them haven't fulfilled that or have even come close to it. So should we really be only focused on this one thing or should we look at this slightly more independently and say, you know what we've seen particularly out of Germany this year as well, it's been such a game changer. It frees up also the capacity for other countries, for other EU members to actually spend more. So it is actually somewhat independent of what happens elsewhere. So that's the first thing. The second thing I would say is where it's priced in is, in fact, in positioning, in sentiment and positioning. What you're still seeing is very subdued sentiment and positioning, which is not only related to, things like geopolitics, but also related to tariffs. And that's good because it keeps the rally going.
Yeah, so you have to look at it to price it through defence stocks, but there's also the oil story, right, and the sanctions story. And if Senator Lindsey Graham gets his sanction bill, and, there's this kind of tension with Trump, waiting for Trump to be ready so that they can be ready, the sanctions on Russia would wreak havoc in the oil markets. So that takes us to the oil story as well, which, as we've mentioned, also links into the OPEC hike over the weekend.
It does, and this is coming in after a series of moves from OPEC Plus. They're trying to regain that market share. We know that, of course, oil has been really pressured and kind of maybe in the Trump administration's book, one of the winners in terms of what this trade policy actually means, because that concern around global growth has been pushing oil prices down so aggressively that's actually created a window for some of OPEC Plus to do it. But why is that market rallying this morning despite risk sentiment being broader? And it's just the fact that as simple as that hike was not as bigger as expected. Max, I'm going to put you here 10 seconds. Is oil a relevant part of the portfolio right now the way that it was 4 years ago?
No, we're underweight. We almost have no exposure to oil at all in our tactical asset allocation, precisely because of this supply glut. It's not really a demand picture, but it's really the supply picture. And also positioning is, in fact, still surprisingly actually not as bearish as it was last summer.
We're certainly going to dive into those details and how this all fits in. Plenty of different investment kind of threads to dive into. There's plenty also going on this week as well in terms of some of the data that we're keeping an eye on. We have ISM manufacturing today, and then plenty of data coming out on Tuesday as well. A series of rate decisions going into the back of the week. It really is all a lead up, I think, to Thursday and Friday, where we do have the ECB rate decision. But then we also have Friedrich Merz meeting Donald Trump, largely going to be talking potentially about the defense story, the trade voice as well, and then U.S. Jobs Day. But Lizzy, you're going to be on the ground in Frankfurt on Thursday. What matters more from your perspective? Is it the defense story? Is it the inflationary story? Is it the trade story? What's on your mind?
Well, it's all going to be on the minds of the ECB. I don't think that there's going to be a very clear signal as to what goes ahead in terms of the path for rates. We've had a really interesting survey showing that economists think that ECB is going to cut twice more. But the question is, do they get it done now, or do they wait for that second cut? Or is it just going to be so much of a headache with the trade story, to your point, for Christine Lagarde to make the communications clear in the interim if they have a long pause? So we'll be watching that very carefully. There's also the drama about the Slovak central bank governor and all of that that's happened this week. I won't get into the details, but that's another bit, an element that we should be watching at the ECB meeting this week. Now, here's what else you need to know this morning, though. Iran has rejected a UN nuclear watchdog report accusing it of nuclear violations, claiming that the agency is motivated by politics. The report says Iran has expanded its stockpile of near-weapons-grade uranium and failed to report nuclear material and activities at 3 locations. Iran says the findings are based on fabricated data and repeated that it's not seeking atomic weapons. Elsewhere, dozens of people have been killed near 2 aid distribution stations in the Gaza Strip. Medics and witnesses say that Israeli forces fired on Palestinians gathering in the southern Rafah and Netzarim corridor. Israel's military denies those claims based on what it calls its initial inquiry. Meanwhile, a US proposal for a ceasefire that would increase aid to Gaza is in limbo after Washington rejected a Hamas counteroffer. And several people have been injured in Boulder, Colorado, in an attack on an event being held to support Israeli hostages. Police say the weapons appear to be bottles of flammable liquid, and a suspect is in custody. Colorado's governor issued a statement condemning all hate-filled attacks. And a nationalist candidate backed by Donald Trump has won Poland's presidential election, defeating the centrist mayor of Warsaw in a blow to the country's pro-EU government. Conservative historian and former boxer Karol Nawrocki won 50.9% of the vote, according to Bloomberg calculations. The result is likely to determine whether Poland remains a reliable partner in the EU and NATO, which face mounting pressure from Trump's tariffs and Russia's threat to the east.
A lot of things to digest there. The geopolitics certainly bleeding into the investment narrative as well. There's one more thing we have to factor in. For our global audience who's perhaps wondering where in the world Guy Johnson is, I'm happy to report he is in New Delhi, India. Let's go there now, where he is, of course, at the IATA World Air Transport Summit. Guy, what are you doing in New Delhi?
As you say, I'm here talking to all the airline CEOs and some of the manufacturers as well, Kriti, at the IATA AGM, which is taking place in New Delhi. Narendra Modi is going to be here a little bit later on, so we're looking forward to hearing what he has to say. But in the meantime, we have been talking to a series of CEOs and some of the manufacturers as well. So you talk to the airlines, they're watching what the demand picture looks like right now. At the moment, it appears that actually the demand picture is okay, but they're all worrying as well about what tariffs are going to do to their business going forward. Are they going to have to pay higher prices? I just had a conversation with the CEO of GE Aerospace, Larry Culp. He says they are already seeing prices going up. They're already feeling the effect of the tariff in their business, and that ultimately is now got to be passed on to the airlines and potentially onto the consumers as well. So how fast does that happen? How much volatility are we going to see around that story? That's a question that everybody's asking here as well, along with what is happening with the demand picture. I've also been talking to a number of airlines who fly into Russia. The story we've seen this morning about the attacks there is also having an impact. All of that is going to continue after the break. We are going to be speaking to Luis Gallego. He is the CEO of IAG. Think Iberia, think British Airways. That conversation is coming up next, right here on the opening trade.
7:17 a.m. in London. Let's get right back to Guy Johnson. He's at the International Air Transport Association, IATA's annual general meeting and World Air Transport Summit over in New Delhi. Guy, over to you.
Lizzy, thank you very much indeed. We have spoken to a whole range of CEOs from around the world already. Let's get a European take on what is happening here. Luis Gallego is the CEO of IAG. Fantastic to see you. Very nice to see you. Update me on what the demand picture looks like right now. What are you seeing? There's been inklings, small signs maybe that we're seeing a slowdown. What's happening right now?
Okay, so thank you for being here today. No, I think what we said in the last results presentation after the Q1 is that we saw in the first quarter very strong demand.
Yep.
It's true that after that we saw some weakness in the economy cabin, mainly point of sale US.
Yep.
But the good thing of the group of IAG is we have different airlines, we operate in different markets with different brands, so we can offset this weakness with other markets that are performing very well. For example, Latin America is very strong, intra-Europe is doing well, and also the premium leisure segment continues very strong. So we don't see a trend that is more several weeks we had that weakness, and we see that the last 3 weeks things are recovering.
Okay, so it's starting to get better again.
Yes.
Why is that slight weakness on the North Atlantic emerging? Is it the weaker dollar, meaning that Americans aren't traveling and maybe to Europe in quite so many numbers? Is it uncertainty? I doubt it's in the economy section of the plane. It's probably not a business story, so it's not the uncertainty coming through. So what do you think is causing that slight slowdown?
I think it's more the uncertainty. I think people, they don't know what's going to happen. Every week we have the different news. We saw, for example, after the announcement about the tariffs, that some corporates, they started slowing the trips.
So it is business demand?
It's business, some business, but it was a good year. Corporate traffic was coming back, but we saw that for a period of time they started to think, okay, maybe we can wait. But I think we don't see this as a structural. It's more until we have more certainty about the future.
The structural bit could be, though, a weaker dollar. If the weaker dollar is there for a while,
yes.
Do you think that could impact people coming, particularly to Europe? American tourists have been a big factor coming into Europe over the last few years. Does that continue?
What we see for the time being is point of sale UK is very strong, and in our case, for example, we have a lot of cost in dollars. So at the end, if we have a weaker dollar, it's helping us in our P&L. So for the time being, we are okay.
In terms of people going to America, do you think that the Trump policy is causing any weakness? Do you think that slightly tougher travel arrangements that the White House is putting into place, particularly around students, actually? I'm hearing a lot of people here talking about the fact that the student market is going to be something that people are going to be watching out for. Is there more resistance from Europeans going to America? In
the markets we operate, we don't see that. So UK, as I said, is working well. Spain is continues booming. We heard other competitors saying that there are markets that they can have more difficulties, but not in our case. Maybe also, I suppose, the agreement between UK and US.
Yeah, I was about to say, did you see, was there an effect from that?
We didn't see an effect before, but I think it's good that at the end we have a frame where we can continue working.
You mentioned just a moment ago that intra-European is quite strong. Is that an indication that people are staying at home? Is that what should I read into that?
No, I think intra-European is strong, and we have Vueling, as you know, that they are performing very well in comparison with the other competitors in Europe. So I think summer is going to be strong. The challenge is going to be the operation, the ATC environment again, but the demand it continues very strong.
Does lower fuel prices mean lower fares? How quickly can we translate one into the other?
Usually this dynamic is the market. It's not only that you reduce the fuel price, you reduce the fares. We are competing with others. We have different levels, for example, of hedging. In our case, for this year, we have hedged 2/3 of the cost of the fuel for the year, but you compete with some people that they don't hedge the fuel, so at the end it's a fine balance.
Right, but you're going to, with the levels they are at the moment, you're going to hedge, you're going to try and lock in some hedging?
Yes, we have a policy in the group, and we are complying with the policy, and we have hedged usually a couple of years.
When we saw that UK trade deal announced, there was a order placed for Boeing aircraft.
Yes.
Now, the connection between the two looks loose. let's put it that way. So I'm interested to sort of get your take on what happens next. Was that you signing up to Boeing in a big way? It obviously was, but does that mean you're excluding Airbus? Are we expecting other orders to come through? Are you still in the market for other wide bodies?
No, I think the tender process for the order that we launched started last year.
Yeah.
As you can imagine, an order for wide bodies is an order for the next 25 years. It's something that is not connected with the situation that we have right now. It's true that we wanted to have more certainty about tariffs. We know that we are not going to have tariffs in UK for products coming from the US.
So you're no tariffs on aerospace products coming out of the United States?
I think we still need more details about the complete aviation picture.
Right.
But in the particular case of aircraft, we are not going to pay tariffs in UK for the Boeing products that we are going to have. But the decision, as I said, we took the decision independently of this. It's true that we said to the UK government that we consider that aviation, we don't need tariffs. I think aviation has developed a lot without tariffs, and we consider that that's the future. But the order that we did that day was 71 aircraft, and I think 32 of them was 787-10 for BA. Also, we announced 777-9 for BA, but the rest were Airbus products because we have, for example, Level, Aer Lingus, Iberia, that where we can allocate the 330 Neos. And also for Iberia, we announced 6 350-900. So
it's going to be BA, Boeing, and the rest of the group Airbus.
But that's the situation mainly that we have now. Instead that BA, we also operate with 350-1000, and we announced also 6 350-1000 for BA. So we choose the product that we consider is better for the type of network that we have. Okay,
final quick question before we let you go. M&A, let's talk about M&A. Portuguese election just happened. What's the latest on TAP? Are you going to buy TAP? Are you still interested in Air Europa? Could that come? Give me the update. Current thinking on M&A in Europe.
No, M&A, I think, starting with Europa, we continue with our 20%. It's a financial investment.
Still a financial investment.
It's a financial investment. Okay. We will evaluate what they do in the future, and then we will take a decision about our stock there. And about TAP, we said previously that we want to know the conditions for the privatization. Now, with the new government, we need to see if they are going to continue with the process that they had in place. I suppose they will continue, and we will have a delay of maybe 2-3 months. But we want to know the conditions, how much do they want to sell, and the freedom we can have to manage the company.
Luis, great to see you. Always nice to spend some time with you. Thank you very much for spending some time with us here on Bloomberg. Luis Gallego, the CEO of IAG. Kriti, I'll hand things back to you. We've still got some great interviews lined up from the IATA AGM. They're going to be coming up throughout the morning. I think we've got Shai Weiss from Virgin coming up a little bit later. We're going to be speaking to the Korean CEO as well. That's going to be an interesting conversation as well, with politics front and centre and the currency volatility to factor in as well. But for now, from New Delhi, back to you.
Guy Johnson in New Delhi bringing us that IAG interview. We thank you so much. He'll be back, of course, later in the show. But he ended with that currency topic. I think it's a crucial one. Guy asks every single person this question on the air. So I'm going to pose it to our guest host this morning, Max Kettner from HSBC. Max, Guy loves to say, what is the currency impact here? Is this kind of European exceptionalism story really something you factor in to the likes of corporate earnings? Your take?
Yeah, it is. I think going forward, in fact, I think the Q2 reporting season, we could, in fact, see actually US earnings be surprisingly strong, because let's remember that when you look at the Magnificent Seven, you look at the mega caps in the US, you've got around 60% of their revenues are generated outside of the US. They're generated from the rest of the world outside of the US. So therefore, the weaker dollar really, really matters for them. And of course, what we've seen now, particularly also Q2 reporting or Q2 expectations have been really, really slashed. So the Mag 7 could really benefit from the weaker dollar.
Yeah, it's a fascinating one. That S&P leadership is already showing up in the tech story. There's going to be a dynamic we digest in the hours coming. Stick with us. This is Bloomberg. 30 minutes away from the start of the opening trade. A lot to digest over the weekend, from a trade truce to the geopolitical developments out of Ukraine and the Middle East as well. You're seeing Eurostoxx 50 futures really sour just in the last 30 minutes, down about 0.6%. The CAC 40 as well following in suit. Where you're not seeing as much pain as the FTSE 100. I think that was an interesting dynamic, Lizzy, that we're going to be diving into shortly. A quick check on the bond market as well as we digest, again, some of this kind of risk-off sentiment around the world, because bonds are selling off as well on both sides of the Atlantic. You are seeing a German 10-year that's higher by 1 basis point. The Italian 10-year higher by about 3, and the U.S. 10-year higher by about 2. So a sell-off across the asset classes, Lizzy.
Yeah, I mean, that's what's happening in the bond market. When we get to the open, of course, we will be watching Polish stocks after the rally so far this year, because Polish media are reporting that the country's prime minister may ask for a vote of confidence this week. That's after a pro-Trump nationalist candidate won the presidential election in a tight race over the weekend. And Bloomberg's Oliver Crook joins us now from the presidential palace over in Warsaw. Ollie, you've had a busy weekend. What's the mood on the ground and the impact of Karol Nawrocki's win?
Yeah, Lizzy, it's really quite quiet, I have to say, this morning. We were here last night when we were sort of getting the early results, and actually the early results indicated that the centrist candidate had sort of won, sort of eking it out, but then we got the sort of final tally this morning saying that the nationalists, the party that was the candidate that was backed by the Law and Justice Party, which is the right wing, had actually won the election here in Poland. There's a very large implications here for Poland. Generally speaking, obviously the prime minister is the main sort of political protagonist, and that's Donald Tusk, who was elected in 2023 with a very sort of rigorous and very large reform agenda that will now be basically halted by the election of the president from the right wing, because the president in Poland has large veto powers. They also nominate the central bank governor, so there's implications for the economy and monetary policy. They can sort of get involved in ambassadorial appointments as well. And so what we're going to have here in Poland likely is going to be more deadlock, and they're not going to bring forward the reforms that Donald Tusk had promised. And part of the reason he was not able to effect those promises over the last couple of years was because of that presidential veto. And that dynamic is set to endure for the coming years after the appointment of the right-wing candidate, Karol Nawrocki, here in Poland.
Walk us through what that means in terms of the implications for the European Union. We know this is a race that was extremely tight. What is the signal for European politics broadly?
Yeah, this is not the outcome, it's fair to say, that you want in Brussels. The Brussels sort of mainstream politicians here wanted another sort of vote of confidence in EU unity. Donald Tusk, as you'll remember, served as the European Council president, a sort of strong and staunch European supporter at a time when the EU is basically waging a form of trade war against the United States. The last thing that you want to see in Brussels is for a sort of nationalist, sort of Eurosceptical candidate that being brought into power in one of the countries that is increasingly a protagonist, as Poland, very sort of active member on discussions about defense. They currently hold the EU rotating presidency as we speak right now, and that is not sort of the message that you want to send to the United States. You want solidarity, you want a message of being able to be on the same page for all of these countries, and that is not what you got out of Poland. We should also say there was a sort of interesting dynamic here where you also had Kriti, the Homeland Security Secretary of the United States, in Poland just a couple of days after the first round of the election, basically endorsing the candidate that won the election, saying that basically the centrist candidate was a train wreck, and that in order to guarantee a good relationship with the United States and support from the United States, they basically should elect the right-wing candidate. And that is exactly what we saw sort of materialize here. I think it's fair to say that most people don't like to be told how to vote, but when you think about the Trump rubric and the MAGA movement, who basically are endorsing this candidate, this is both good for them in terms of the conservative values that they espouse, but also undermining the European position, particularly on things like the trade negotiations.
Bloomberg's Oliver Crook in Warsaw, covering a crucial election when it comes, of course, to the defense story, but also the trade negotiations. As he says, we thank you so much and look forward to that continued coverage out of Warsaw. Let's talk about what this means for the markets, though, because, again, we are trying to digest several different investment threads this morning. I'm joined now this morning by our guest host, by the way, Max Kettner from HSBC, alongside Bloomberg's Valerie Teitel, our markets correspondent, to kind of make sense of how we should be positioning 30 minutes into, or actually 30 minutes away, 25 minutes, if I'm trying to do my math correctly, into the open. It's Monday. I know. Give me a little grace here. But Max, let me come to you. We're talking about these geopolitical developments. We're seeing risk sentiment sour this morning. I mean, what do you do in this environment when 15 minutes ago we posed this question to you? You kind of said maybe there is a little bit of complacency because there's no other choice. What do you do as an investor?
Yeah, look, I wouldn't necessarily characterize it as complacency, because what is striking to me is when we look at least at our positioning indicators, we've had this massive rally in equities, in credit spreads, really across the board in risk assets, and it does feel like complacency. I think the sort of consensus is almost like, okay, you know what, we've rallied back, it's all in the price, we're back to pre-liberation levels, so surely everyone's got to be back in. But in fact, when you look at positioning, you look at CTAs, you look at vol target funds, you look at risk parity funds, you look at trend following indicators, all of the systematic stuff from us is round about 10th percentile. So they have rebuilt a little bit. I'll give you an example. Vol target funds, they've gone from around 20th to 35th percentile. So it sounds like a huge step, but we're coming from 80th percentile equity exposure. So the delta over the last month, surely, they've backed up a bit, but in terms of the level, they've got so much space to still go. So I think what investors should be doing is, and what they should be looking out for, which is one of the questions that we get the most frequent, is, so what's the next catalyst, right? We had all these headlines around tariffs, but what's the next catalyst? I would say, and I know it sounds stupid, it's not the most stupid thing, and, it's Monday, it's certainly not the most stupid thing that I've ever said, right? But I think, honestly, it's like things like benign nothingness is certainly enough, because what you'll see is realized volatility going down, you get things calming down, but just a lack of further bad news. You don't need massively better news, just a lack of further negative news. And that already brings realized vol down, and it frees up space for particularly the systematic investors and strategies to buy.
That is fascinating. This is quite literally, you were describing a lot of fancy jargon for saying no news is good news, basically. Val, hop on in here, because you cover day in, day out some of this volatility. I know you said this last week and scandalized Guy and I think this is crucial, because the volatility story has been so pronounced in the bond market and the FX market. But to Max's point, has calmed down in the equity market. What gives?
No, I mean, I think I agree with the sentiment here. It's bullish for me, right? And you have to combine the fact that, yes, we're having a decrease of uncertainty, a decrease of vol. Combine that with the fact that you have governments spending around the world, this fiscal impulse from the U.S., from Canada, from Germany. I mean, even Brazil, even some EM nations are doing it as well. To me, that's the big bull case for the equity market here. We didn't get the bond market blow up that would defer that kind of fiscal spending. And instead, it's only going to come quicker and faster. And to me, that's the bull case for the equity market. I mean, I was even thinking on my week off, don't laugh, about the fact that maybe we can even see credit spreads go negative in some way. Because, yes, you have government balance sheets deteriorating, but corporate balance sheets are doing quite well, and the U.S. economy is doing quite well. What do you think about that, Max?
Yeah, look, I think on the U.S. economy, I mean, when you look at the GDP now, right, it looks fantastic. It looks exactly the opposite, the mirror image of what we've had in Q1. So that is, in fact, pretty supportive. I do think on equities overall, now I sound really bullish, and I'm neutral US equities. So, it's a bit like, what are you doing, Max? So I do see that maybe we've come off a bit, like, a little bit too quickly from the lows. And yes, there can be the hiccups in between. No? Like we've seen the steel tariffs on Friday. But the point is, what we've discussed at the top of the hour 45 minutes ago was the sensitivity of the market to those tariffs has gone down. So you might get these sort of 1%, 2%, 3% dips, but they might even actually just be intraday dips. So I can't publish quickly enough to buy these dips, right? To be like, right, guys, like you need to get back in. And I think that is where the pain trade right now is that a lot of people just basically saying, you know what, I kind of missed the rally, but there's going to be these bumps along the road, and then I'll buy the dip. Which means particularly when you look at, again, across positioning, I know I'm going to keep banging on about it, but when you look even at long onlys have gone from pretty sizable overweight in equities to pretty much neutral at the moment, and they've gone outright underweight in high yield credit. So there's a lot of pain, I think, to come. The pain trade really being, you know what, we've missed this. We've probably been late in selling. Now we've missed this. We kind of need to find a way to get back in. To me, where we are right now, in a space of a lack of catalyst fundamentally in the next couple of weeks, that does argue for a bit more credit, a bit more, to your point, right, a bit more high yield credit, short-dated emerging market credit with the weaker dollar and stuff like that.
Can I interrupt the ball first? I mean, first of all, surely all the while you're floating amidst all this uncertainty, you're just getting more of a hit to business investment, you're just getting more of a hit to growth in the US. And as I said before, you've got to wait for this reckoning. And back to your point, Val, did you see that analysis from Torsten Slok over the weekend?
Tell me.
That government credit default swap spreads trading at similar levels to Greece and Italy. Come on.
Yeah, but I mean, you can argue, though, that Treasury yields have not delinked from nominal GDP. So I don't think there has been a default premium baked into the Treasury market. And you know I was very bearish on Treasuries recently, but I think
complete 180 from Valerie's
we have not gotten the Treasury market blow up. 10-year yields trading below 450. You know, that's pretty in line with where nominal GDP is in the U.S. And I think in absence of that, you know, it's risk on from here. But I do think there's some interesting price action going on today. It is risk off. We do have the dollar declining. And I think that is another signal that perhaps these foreign investors, when they do pile into U.S. equities, they might do it in a hedged basis, and that could keep a downdraft on the dollar in the coming months.
Yeah, and Morgan Stanley seeing the dollar falling 9% on the slowing growth bets that I'm referring to, Max. Is that exaggerated?
That's great. That's fantastic. No, it's bullish. It's bullish on equities. No, think about it. So we've got to, I think we've got to talk about, okay, weaker US, perhaps some sort of, you know, what Valerie was talking about with perhaps going forward hedge ratios up, right? We know that from some data that the hedge ratios are significantly below the long-term averages. What does that mean for equities, or what does that mean for the overall trade? I think we've got to go from one asset class to the other one. And when you look at, you know, when you look at FX, sure, right, dollar should be taking a little bit of a further hit, right? Probably nothing massive, but should be trading a bit more on the weaker side. Then you go to rates and you're saying, yeah, you know what? The way that we've got term premium built in right now, the way that basically the long end is trading at 440. I mean, I don't know about Valerie, but to me, that does not look like fair value. To me, that probably should be going more towards 5%. I'm not sure we can hit the 5%, but certainly a further underperformance against risk here, because nominal GDP growth, good, right? We have obviously tariff stagflation fears, right? We've got the fears around debt sustainability, and particularly on the very long end. Why should I stop testing the market? Why should I stop testing the Treasury until they fold, until they give me some kind of concession? So the rates trade, yeah, that also is a bit weaker US. You can play that with 530s, 1030 steepener, or long end short. But then you look at credit, actually, that allegedly US end exceptionalism, the end of it, does that affect the technical picture? Does it affect the flow picture in credit? Does it affect the maturity wall in credit? Nah. Not really. So I'm like, yeah, fine, credit's totally fine. I look at equities. We've talked about the FX impact. You look at the Q2 reporting season, you look at Q2 earnings expectations. They've been slashed massively. And now we've got 10% weaker dollar at DXY compared to the peak in January. So in reality, you know, you're one of the mega caps. And you look at this, I'm like, I'm loving this. No, this is fantastic. So I look at this, I'm like, you know what? There's a genuine case to be made that we're going into July and August, and the Q2 reporting season suddenly, among the largest 20-50 companies in the S&P, sounds really, really bullish, because the FX impact is more than outweighing the tariff and the growth impact.
Yeah, but Max, do you think we return to that kind of January euphoria where business sentiment was just booming and Trump was back in the office, everyone was excited? Do you think we get back to that kind of excitement?
Hopefully not. Because then it's, you know, but it comes back to my point about positioning. What we've talked about, or the question you guys have been asking me is bearish. I'm like, no, bullish. You know, that's sort of what we've been doing the last 45 minutes. Whereas I think that's a real danger. If we go back to this, okay, to be fair, I was kind of the same in January, to be like, why should I look at Europe? Why should I look at EM? Why should I look at anything else other than US credit, US equities? Just buy US and shun everything else. We don't want to come back to that. What we do want is this sort of underlying, yeah, okay, so yields up, but the dollar down? Oh, God, maybe this end of US exceptionalism trade is not yet over. And, oh, God, yeah, we still have a bit of tariff uncertainty. We still have uncertainty. Maybe so much activity has been front-loaded in Q2. That is a case to be made as well. I don't necessarily buy it, but I think quite a lot of people are saying, you know, what we're seeing right now in Q2, GDP now is almost 4%. Why? Because we're front-loading so much demand that actually in H2 we'll have a bit of a payback. Again, I don't necessarily buy it, but that's one of one sort of cloud that is then overhanging over positioning as well, that's great, because what it does is it keeps positioning in check. And as long as that is in check, as long as, I think that, or let's put it that way, the dangerous thing will be if next time we'll all be here on the table and we'll all be like, yeah, we kind of agree on everything, and let's talk about that for the next hour. I think that's the dangerous territory where we really don't want to get to, unless, until it's like that.
Well,
it's
indeed,
great.
That would be boring, Max. But lest I curb your enthusiasm, stay with us, Max. We're going to keep you around the table. Max Kettner of HSBC and Bloomberg's Valerie Teitel, we thank you. Coming up on the programme, it's an M&A Monday for Sanofi, the company announcing it's going to be buying Blueprint Medicines for just over $9 billion equity value. Sanofi is one of our today stocks to watch. So stay with us. This is Bloomberg.
About 12 minutes away from the opening trade across Europe. Futures pointing a little bit lower. Let's get a little bit more analysis here. Bloomberg cross-asset strategist Ben Rom joins us this morning. Ben, lots of threads to kind of tie together when it comes to the investment theme this morning. What is top of mind for you on this Monday? Is it the trade truce kind of falling apart? Is it the geopolitics coming out of between Europe and the U.S., or perhaps even some of the defense developments out of Ukraine or in the Middle East? What is top of mind for you this morning, Ben?
Top of mind for me are two things, Kriti. One is the geopolitics that you mentioned that is keeping gold very well bid, and I think that gold has short-term potential. But longer term, I'm a bit bearish on gold. But top of my mind is what is really happening on the trade front, Kriti, because we have heard from Trump that he wants to double tariffs on steel and aluminum to 50%. And he's also traded bombs with China on the trade dispute. So this issue of tariffs is not going to go away. And that's going to be a drag on earnings. That's going to be a drag on corporate earnings. And the question is, how far is our earnings going to be compressed? Now, the Bloomberg point estimate for earnings, S&P 500 earnings, is $264 on the aggregate. Now, even taking it at face value, and assuming an 18 times earnings multiple would give you then would put the S&P around 4,800. We are about 1,100 points higher than that. Obviously, there's got to be an earnings compression from here, Kriti, because what the S&P, what investors are willing to pay on the S&P is like 23 times earnings. I don't think that is sustainable. That is sustainable in an environment where 2023, where we saw that magnificent 7 Boeing earnings, and investors were willing to pay for those earnings. But 23 times, to put it in historical perspective, the long-term earnings yield of the S&P is about 5.2% or 17.2%, 17.2 times earnings multiple. We are 23 times, as I said, and that is not sustainable. And I think that's got to come down, especially in an environment where the visibility on earnings is not very clear.
All right, Ben, and just take us through what to expect on Thursday, because, of course, we're looking ahead to the ECB meeting, a cut fully priced by a quarter point, and it doesn't look like we're going to get much of a signal on what lies ahead. So is this going to be a nothing burger of a meeting?
No, I think it's going to be actually an interesting meeting. As you said, that, investors have fully priced in one rate cut from the ECB. The question is whether they indicate one or further rate cuts after Thursday. Now, my conviction is that they're going to point to one more rate cut beyond Thursday, because that will take them to the nominal neutral rate, which is at 175. And I think they will stop there. The question is if they go beyond there, but that will come down to trade tariffs and all those uncertainties hanging over Eurozone. But I don't think that if you look at some of the governing council members, nobody has given an inkling that they're willing to go below 175. So I think that is an ECB that is almost done on rate cuts is going to be very positive for the euro and negative for the dollar.
Yeah. Certainly something we're going to be keeping a very close eye on. 113 this morning on Eurodollar. Venram, we thank you so much. Analysis this morning of Dubai, Bloomberg's cross-asset strategist. Let's get our stocks to watch as well, from the macro to the micro. There are a couple that are catching our eye this morning, specifically in the pharmaceutical sector, because as we mentioned earlier, there is an M&A story coming on Sanofi as well. So we're going to keep one eye on that. They're buying Blueprint Medicines for about $129 per share in cash. But this also comes off the leg of some news over the weekend that it looks like some of these big names, AstraZeneca, among others, and Roche as well, actually getting some positive results when it comes to cancer trials. We'll see if that's factored in to the open in just a few minutes, Lizzy.
Yeah, we also need to take account of the impact of the tariff story over the weekend. Of course, Trump announcing this doubling of steel and aluminium tariffs from 25 to 50%. And you're already seeing Arcelormittal shares falling on Tradegate against the Amsterdam close. So we're expecting to see that pain happening in the European trade. You've already seen US steel companies rallying and extended trading. So this is the flip side of that, Kriti.
Absolutely. And we should talk about another sector that, of course, we keep coming back to, especially today, and that is the defense sector. I should mention that the DAX futures are down about 0.6%. But you can see the massive rally on a one-year basis in terms of the defense story. The news this morning in terms of long-range attacks from Ukraine and from Moscow, I'm curious what that does to the open. Max Kettner, of course, from HSBC, has been guest hosting this hour. He's the chief multi-asset strategist there, joins us around the table. I'm confused by this market reaction on a day where we have such clear geopolitical news. We have such a scary kind of front when it comes to Ukraine and these long-range attacks, the longest they've ever had going into Russia, getting the backing of the German government and largely the United States as well, at least under the Biden administration. So why are defense futures, or why are potentially defense stocks down if you're not seeing it reflected in the index? What could the logic be?
Well, you could say that perhaps it is an FX impact as well. No, you see the dollar down, you see euro up, so you see cable obviously up as well. So you could perhaps make, at least today, the link with FX a bit, that, OK, they're actually exporting quite a bit, so therefore maybe it's defense stocks. But overall, looking beyond what they might be doing today, I mean, number one, what it does tell us as well is that the overall sensitivity of the equity market and risk assets overall, I think, to geopolitics has really, really come down as well. That is number one. Number two, I think overall defense stocks, like we said, it is not just related to the headlines. It's not just related to what's going to happen around Russia, Ukraine. It is also related really to, let's say, the NATO summit, I think in 3 weeks' time, where most likely we will have more commitments, and after that, even more commitments to come from EU member states. And that is not a story for just today, but a structural story.
Absolutely. Something we're going to see how much of that is priced in the market. Max, pleasure to have you this hour. It has flown by. We've picked your brain on everything from oil to FX to the stock market and, of course, defense as well. Max Kettner there, the HSB chief multi-asset strategist this morning. 5 minutes away to the opening trade. Stick with us. This is Bloomberg. We are just a few minutes away from the opening trade across Europe. So let's talk about how we're set up into this opening trade, because we did see a little bit of risk-off sentiment when it came to the stock 600 on Friday. So a sell-off there, but then a rally into the close when it came to the U.S. Some that's going to come up from the data as well. Futures telling a little bit of a different story. So the sell-off, to me, at least, continues when it comes to the stock 600, but perhaps setting a negative tone for what's happening in the States. And I think of that entire story, the trade deal, the defense story, the key piece for me is this divergence right here between the FTSE 100, which is only down 0.2%, despite digesting that same kind of fear-mongering, that doomsday narrative you're seeing in the markets this morning, alongside the DAX futures, which are down about 0.7%. Traditionally, when we get geopolitical headlines from the likes of Ukraine and Russia, you are seeing DAX futures soaring as a function of that defense trade, Lizzy. I'm curious if we see that today.
Yeah, let's start with that. If we turn to our stocks to watch then, Kriti, as you say, DAX futures underperforming the rest of Europe. Maybe we're going to see that in the defense story this morning. It's strange, perhaps, given the ramping up of strikes of Ukraine on Russia. Also, Moscow launching one of its longest drone and missile attacks against Kyiv. But also, we've seen the UK plan to spend £1.5 billion on munitions factories and expanding its submarines. So we keep an eye on UK defence stocks as well. We look at Arcelormittal shares falling on Tradegate because, of course, we factor in those doubled steel and aluminium tariffs from Trump on Friday. And we watch Sanofi as well because it's An M&A Monday, we have Sanofi to buy Blueprint Medicines for $9 billion of equity value. So a lot to keep our eye on as we head towards the open, Kriti.
It's a fascinating one as well because a lot of those sectors might actually have ripple effects when it comes to the actual index story. So ArcelorMittal, how does that show up in perhaps the FTSE 100? Maybe that metals trade is the divergence we're seeing. Well, we don't have to guess anymore. Let me bring you the opening trade right off the bat. FTSE 100 virtually flat at this open. It doesn't tell you a whole lot about the excitement you're seeing in the FTSE 100, which is that where that divergence to me really stands out. You got the IBEX right out the gates as well, down about 0.3%, taking a minute for the stock 600, taking a minute for the CAC 40. There it is on the stock 600, down about 0.2%. Not necessarily reflecting the same pain trade you perhaps saw in that futures picture. I was just pointing to a stock 600 with a 0.6% decline. We are not seeing that just yet. And the DAX right off the bat, there it is. There's that pain trade, which Lizzy tells me very quickly there's risk sentiment across the board. The idea of that geopolitical risk, both emanating from the States and from Europe, is perhaps what's weighing on these markets across the board.
Yeah, so we've got pain red across the screen for European equities this morning. If you break it down by sector, all but 3 sectors are in negative territory as things stand. Tech is at the bottom of the basket, down 1.3%. Autos and parts not far behind it, down 1%. Consumer products and services just behind that as well. So that's your sectoral breakdown. We did mention that you could have a movement on Arcelormittal shares. They're down more than 1%. As we say, reacting to that tariff news, Trump doubling the steel and aluminium tariffs, and Arcelormittal, of course, a steel maker. And so that pain is already showing up. We talked about defence as well, and we are off to the races for Rheinmetall, up 2.3%, Saab up 1.4%, Leonardo up 1.5%, BAE Systems getting that extra boost, of course, from that UK defence spending, and that's up 1.6%. But a bit of weakness for Safran and Airbus, notably.
It's a fascinating one as well to see this divergence. And you mentioned the defense story, you mentioned the Rheinmetall as well as one example. But this, from a sector perspective, is a decidedly defensive day. And I'm curious whether that's simply waiting for the U.S. markets to open, waiting for a little bit of cautiousness there. The pharmaceutical sector right out of the gate, Novartis, for example, GSK, one of your biggest movers that you are seeing, gaining about 1.5%. GSK higher by 0.7%. And Novo, of course, so that's kind of the vol trade in pharma at the moment. So higher by 2% and 2.4% as I speak.
Yeah, and also I did say that we needed to keep an eye on Poland. The WIG 20 down 3.1% off the back of that election result, the Trump candidate winning in a real nail-biter of a race. Yeah. So Polish stocks, despite their rally so far this year, not happy this morning.
And we should just mention the fact that just because you mentioned the Polish piece of this equation, Poland is not an economy or stock market that we talk about very often on this show. But admittedly, but perhaps we should, because it is actually one of the best performing. And a lot of that is because of the migration story that's going in there. A lot of that is just this economic growth that is unmatched by others. Poland is one of the few countries in Europe that's actually meeting that 5% defense target.
Yeah, and we had a fantastic piece from our colleague Michael Masika about the outperformance of European stocks. But keep an eye on the periphery, is what analysts were telling him. And I thought it was interesting that Ghanaian stocks were the top of that leaderboard. But let's discuss more. We've got Laura Cooper, Head of Macro Credit and Global Investment Strategist over at Nuveen, with us round the table. Good morning, Laura. Just take us through what you make of the moves that you're seeing in the markets this morning. I think we need to start with the defence story, because that's what we're really trying to make sense of. We've got underperformance for the DAX, but we have got outperformance for the likes of Rheinmetall. How do you factor in such massive news around what's happened in Ukraine and Moscow over the weekend?
Well, I think when it comes to European equities and what we're seeing in the German DAX, it's important to acknowledge the starting point. This is an equity market that has had remarkable gains year to date, really surpassing its peers. And I think there's a question around kind of that performance and as well valuations. I mean, the German DAX is trading at 15, 16 times price to earnings. So I think there was a little bit of nervousness that had gone too far. So I think the fact that we are seeing geopolitical tensions come through, yes, one would think that that should bolster those defense stocks, but we're coming from already a high starting point. I think over the medium term, this is certainly warranted, but in the near term, I think there's more caution still to play out.
And when you talk about Poland, as we admit we don't do very often, is it the periphery that you need to be keeping an eye on at the moment?
I think more broadly, it's the risk premium that it needs to be baked in on the back of a number of uncertainties, whether that's coming through on unknown tariff news or whether it's geopolitics. The fact that we have seen European equities outperform the U.S. quite robustly year to date. I think there is a question of how much more can that reallocation away from U.S. assets persist. If we look at what happened more recently in earnings, the tech earnings in the U.S. were so pronounced. I think that does warrant a rethink of some of those large cap positions in the U.S., particularly in this environment where we are seeing volatility become more subdued.
I think one of the key questions as well, I mean, Lizzy approached it from a defense sector perspective and kind of where does that underlying investment strategy work, but just from a risk sentiment perspective. We've been talking for years about the fact that there is perhaps a little less of, I don't want to put complacency as the key word there, but complacency or a little bit of less of a factoring of the Ukrainian story into your broader investment thesis. Today seems to be a little bit different, and I'm curious what that red line is, given that in the last week or so, we've now seen Germany take a much heavier involvement, a much heavier say than the United States. Is that something the markets are missing?
I think it's very hard to price in geopolitical risks. Typically, when we do see a catalyst like a significant event, we have a knee-jerk reaction in markets, but it does tend to fade. I think the key question is how does one position in a potential multipolar world where we don't necessarily have that one global powerhouse going forward? And I think markets are still recalibrating to what that potential new regime looks like. I think the way we're positioning it is still looking at this is a backdrop where markets are increasingly discounting the tariff news. You know, there is still that tariff risk premium that needs to come through. And I think we're more focused on the extent of economic damage that is potentially going to come through in U.S. data, most particularly because of the uncertainty around a number of these factors, geopolitics and trade, but as well just how much we're going to see cracks in the labor market. I think that's a key focus for investors, certainly this week.
I was about to say on Friday, it's a perfect preview on Monday, but give us that sentiment change, if you will. We've seen an uptick in initial jobless claims, for example, last week. Where's the red flag in this data?
Well, I think the conundrum has really been we've seen a deterioration in soft data for quite some time. OK, when is that hard data going to catch down? But now we're in an environment where that soft data is starting to stabilize. So if we do see, the dents come through in the labor market, maybe some of that stabilization in soft data will have investors believing that that economic damage will be fairly short-lived and fairly limited. So I think almost in a sense we're going to have a bit of a balance in terms of soft data catching up and that hard data catching down. So I think it is yet to come in terms of the payrolls. But we'll be watching certainly to see whether it falls off a cliff. That's not our expectation. But I think markets, are certainly waiting for that next catalyst.
The soft data is so funny because, and I say this almost comically, because we're talking about things like TSA data, for example, or TSA pre-check data, airport travelers, foot traffic in Starbucks, for example. So much of that is sentiment-driven. So much of that is headline-driven, that tariffs are going to bring up the cost of iPhones, and therefore people are going to stop spending for a month. The Fed and other central banks love to say we're data dependent. They love to say one data point isn't enough. How many data points are enough to get a more pronounced monetary policy reaction in either direction?
Well, I think the key challenge is that we really saw that peak tariff backdrop was in early April. We don't have enough hard economic data given the short time frame. So we have to rely on some of those high frequency indicators, particularly around the consumer, given the consumer is such a prominent component of the U.S. economy. I think from a central bank perspective, we had Waller comments overnight that really did signal that, perhaps the inflationary backdrop will be fairly transitory because consumers aren't going to have higher nominal wages. They're not going to go out and spend, but they could curtail their discretionary spending. They could actually start to see those cracks in the labor market. So we'll be watching key indicators like vehicle sales. We'll be watching retail sales because we think a lot of the boosts that we've seen to start the year maybe have been some front loading ahead of those tariffs. So I think we'll be watching some of those key indicators, but I think for the Fed, it's really all about the payrolls data coming through. We need to see it in the hard economic data.
What about the ECB? Because I think it's interesting that you only see one ECB cut nailed on for the rest of the year. Why is that when the market's so sure we're going to get two?
I think that view is largely predicated on the fact that the tail risk around a substantial trade war has essentially been reduced. We're seeing consumer sentiment gauges improve in Europe. We are seeing an uptake of credit. And that fiscal impulse, yes, we have yet to see it come through, but we still think that has to be a part of the ECB calculus. So we think the Governing Council is going to be comfortable getting to just the top of their neutral range at 2%. We removed that additional 25 basis point insurance cut. But again, to Kriti's point, this is all about data dependence. We think September maybe is a risk of another cut, but we're leaning against that. If anything, we could see some of that defense spending brought forward sooner, and I think that's a risk that markets are not yet positioned for.
But if we bring that back to the European equity story, right, you've got, as you say, this room for fiscal boost to growth. Others at least think that there's more room for the ECB to cut. Others say that, equity valuations aren't stretched. So why do you argue then that there's limited upside for European equities, or that the growth is set to slow?
I think the growth is set to slow just given the remarkable pace of gains that we've seen year to date led by Germany. And a lot of that is already baking in that fiscal stimulus sentiment. I think if we look at what the outperformers have been, we expect utilities, industrials, financials to continue to be the ballast of support in Europe. But it's more of those cyclicals that have struggled. We think those are going to continue to be challenged, whether that's, chemicals, consumer discretionary. I think it's really a bifurcated market. It's about the dispersion and really one that warrants very selective approach within Europe.
So much of, and you mentioned this kind of outperformance in Germany that's been driving the European market, at least in the first quarter. There has been a key question about the structural shift in portfolios, that you just want to deleverage from the United States, and that is the bulk of what these kind of repatriation flows have been, at least to Europe, and also American allocators to Europe as well. Is that over? Is that structural shift over?
I think it's a question of whether this was actually a structural shift or whether this was just a tactical reallocation on the back of relative attractive valuations, and as well as some of that growth catalyst that we did see coming through in Europe. I think U.S. equities, there's still a fundamental story at play. Even if we do see this policy uncertainty extend, that's largely predicated on a lot of those tech stocks really being the engine of earnings growth. They had more than 30% earnings in the first quarter relative to the rest of the S&P 493 of only 8%. So there is still that robust earnings backdrop that we think can support U.S. equities. And I think as well, to your story, it was really more of an equity story. Have we seen that kind of foreign appetite dry up for U.S. Treasuries? Well, not necessarily. I think, if anything, we're just seeing a repositioning across the curve in the U.S. We're preferring short duration exposures because more of the fiscal dynamics that are coming through in the U.S. But we're not necessarily seeing a flight away from Treasuries despite the uncertainty.
Do you think that's coming in July when we hit that debt ceiling and the deficit widens, or if this tax bill over in the States makes it through Congress? Do you think that kind of flight, I should say, from Treasuries is coming upon us?
I don't think that's necessarily the case because there really is no other alternative at this juncture if we think about this on a structural basis. I think what we are going to see, though, is we're already seeing in the bond market is further curve steepening. We're going to see investors demand that higher term premium. We've already seen it rise quite significantly, above 90 basis points, looking at that 10-year tenor. That lack of fiscal restraint that will require higher yields to maintain that demand base for U.S. Treasuries. So I think that's one of the ways that we're playing it, that curve steepening, and then looking at those short duration exposures, because it is much more anchored. And yes, there's risks around the Fed. We have the SEP coming up. If they say, well, maybe we only want one cut this year instead of two, that's going to have a risk. But I think really your risk reward is beneficial if you stay in that front end.
Fascinating stuff. Laura Cooper, head of macro credit and global investment strategist at Nuveen, joining us this morning to talk to us a little bit about what that European trade looks like across the asset classes. We thank you so much. In the meantime, let's make a quick look at the core six. Come back to this equity market because a couple of different themes that we're keeping an eye on. Novo Nordisk is your sole outperformer out of the core six, higher by 1.4%. That is a pharmaceutical story, one from cancer drugs, kind of trial drugs over the weekend, getting a little bit of some positive news there, but also a little bit of perhaps of the Roche Sanofi M&A Monday story as well. So the pharmaceutical sector seems to be, I think, leading the defensive charge this morning, at least to the upside. The rest are very much in the red. ASML, I think, is your heavyweight down there, about 1.5%, and one of your biggest contributors to the downside on the Stock 600. We're going to keep you apprised of these market moves. Stick with us. Coming up on the program, UK challenger bank Monzo reporting record profit. The group's CEO is going to be joining the program next. Stick with us. This is Bloomberg.
Welcome back to the opening trade. We are 17 minutes into today's session, and you can see the Stock 600 down 0.2%. Lots of geopolitical news to factor in this morning. Slight upside for stocks in London, and that's where we're going to go to next. UK challenger bank Monzo has reported 48% revenue growth and an eightfold increase in profits for the year to the end of March. Monzo, which first returned profitable in June of last year, now boasts more than 12 million customers. So I'm pleased to say we are now joined by Monzo's Group CEO, T.S. Anil. T.S., good morning to you. Thank you so much for being with us this morning. I note that you've raised hundreds of millions of dollars last year to try and finally crack the US market. That's an area that we're looking at in these results this morning. How is that effort going?
Thanks for having me, Lizzy, and thanks for the highlighting the big results that we had last year. We raised capital to build out the Monzo business, both here in the UK and expand our international ambitions as well. And that capital has been deployed, as you can tell, in growing customers, more products, and in turn, more geographies as well. The US is a part of that strategy as we look to expanding globally and making sure that every part of the world has the Monzo. In the US, we're still at the early stages of building the right product for customers, learning from customers, and iterating to make sure that we can build the best bank for the American customer. Internationally, we're also building out our strategy in Europe, as we're public about, and we've got we're domiciled out of Ireland, and we're building out the European strategy as well.
And are you partnering with local banks on the ground, or are you considering outright buying a US bank to try and help with that expansion in the US?
So the US has a pretty well-established model of fintech players partnering with sponsor banks in the US, and that's exactly what we're doing as well. We're focused on making sure that what Monzo brings uniquely to the American customer is a product that brings all of your money needs in a single place and lets you meet your needs of budgeting and borrowing and spending and saving and insuring all in a single place, and doing that with delight and changing your relationship with money. To do all of those things, we partner with a local bank.
Well, talk to us about the bigger banks. In terms of expansion, Lizzy there was talking a little bit about partnering and your expansion efforts in the United States in terms of a listing, but talk to us about partnering with potentially a larger Wall Street bank at the same time that they're trying to do exactly what you just outlined.
It's pretty clear to us that other than the sponsor bank relationship that we will require in the US, here in the UK, as we've scaled our business, we're now 12 million customers in the UK. We're one of the largest banks in the UK, period. We don't need to partner with a local bank to do that. And the important thing over here is that the power of our product and this idea of bringing the best of technology and the best of banking together to transform people's relationship with money is the mission that we're embarked on. And it doesn't require, partnering with Wall Street banks or any of that to build that out. We've clearly shown that we can distribute and scale ourselves.
T.S., talk to us a little bit then about just kind of when it looks in terms of the products that you're offering your customers. When I think of Monzo, I think of it more as kind of a debit account or a deposit account. But there is talks, at least, that Monzo's looking to expand into the credit and lending space as well. Your thoughts on the latest and the risks that might come attached with that?
Well, so in the UK, we help customers budget and borrow and spend and save and insure and invest. So it's across all of the financial needs of a customer. We're early in the US, if your question is specifically about the US product, where the US product is oriented first towards budgeting and transacting tools, and over time it will have everything else as well. But in the UK,
and there's been reporting recently, T.S., about potential listing that you've been lining bankers up. Is that true?
It's too early to talk about it, Lizzy. What we're focused on is scaling our business, reaching more customers with more products. And, we will make a great public company one day. It's just too early to talk about it.
But when that day comes, are you considering London or New York? Do you have a preference?
It's too early to talk about it, Lizzy.
Well, you got to give her credit for trying, T.S. You absolutely have to. And when you do make that decision, we look forward to having it right here on Bloomberg. But, T.S., walk us through what, perhaps, if you don't know where in New York or in London that listing may be, what the Labour government can perhaps do to make London a little bit more enticing. This is a conversation we have with your peers across the financial and tech sectors all the time.
Yeah, look, like other tech companies and private companies, we've worked with this government as well as with policymakers across the board to continue to make the UK, even more attractive. But it's way too early for us to really talk about specifics of what it will take, and when we get to making a decision.
But is the point that they're not hitting the mark for you yet because you're not even thinking about listing in London yet?
it's too early to talk about it, Lizzy, because what we're focused on is actually building the business and scaling it, improving, continue to reach more people, more customers, more products, as I said.
TS, talk to us a little bit about the kind of consumer you're reaching. I'm really curious about this. When you talk about your next leg of demographics that might be interested in a Monzo account, for example, who are you targeting here when some of your rivals are really kind of targeting, I want to say, newbies to the labor market, the younger demographic? What does that do for you in terms of the competitive landscape?
Sure. So there's a couple of things over here. Like most digital adoption curves, your early customers tend to be more tech savvy and often younger customers. But what we're playing to be is a universal bank. Our mission is making money work for everyone. And that means meeting financial needs of everybody across the board in a single place. And so, we have hundreds of customers, even in the 90s, who bank with us. And, last I checked, 2 customers more than 100 years old who banked with Monzo as well, proving this idea that simplifying money and changing people's relationship with their money is a universal need across demographics, and we expect to meet everybody's needs. And in any sort of new adoption sort of context, in a new market with a new product, you sometimes see younger customers as the place it starts, but eventually we want to meet everybody's needs.
Just coming back to the US market, TS, just a few years ago you withdrew your US banking license from the OCC because of the engagement that you'd been having with regulators at the time. Now that President Trump is in office and pursuing this agenda of deregulation, I want to ask you if you think it would be easier to pursue a license yourself, what your early conversations have been like with the Trump administration and the regulators.
Yeah, like I said, in the US, what we're focused on is building the right product for the American customer and to meet their needs. And we know that in the US, having a banking license is not a must-have to be able to do that, given the sponsor bank model works incredibly well as well. So right now we're focused on the product, Lizzy.
Monzo Group CEO T.S. Anil, we'll leave the conversation there. We look forward to having you back again when you decide where that listing is coming from and where you go forward with your business. We thank you so much for your time this morning. Thanks. Lizzy, I want to bring it right back to you here because, of course, we've been having this big conversation with TS there about where this UK environment is in terms of growing a business, in terms of investing, et cetera. Some news coming out over the weekend, I believe, when it comes to the non-dom status. Can you just walk us through it for our global audience?
Yeah, so wealthy non-doms exodus. This is a concern, of course, at the moment that because of the regime change under the Labour government, that actually more non-doms are going to leave than the Office for Budget Responsibility is estimating, and that's going to mean that it costs the UK Treasury more than it raises. And so this new report by Chris Walker, former member of the government's economics service, founder of the consultancy Chamberlain Walker Economics, sees that number topping 10% and more to come. And that's an interesting number to me because the Centre for Economic and Business Research says that if more than 1 in 4 non-doms leaves the UK, then you're going to hit that crunch point where actually it costs more than it raises. So it looks like we're heading towards that according to this new report, but not quite there.
What's the reaction function to that? I mean, if we hit that red line in the sand that you just outlined, what happens next? Well,
there is the argument that Labour could just bring the policy back with a completely different name. I remember speaking to a Conservative Chancellor before the election that brought Labour in, a former Conservative Chancellor saying it'll just be back with another form. But who knows what form that would take. It just comes down to whether the UK government is alive to this competition when you've got the likes of Monaco and Milan, the Middle East even, vying for these non-doms, these globally mobile, wealthy individuals to come to them and bring the investment and jobs that comes with that wealth.
Absolutely. That foreign and direct investment that we're seeing from abroad, this is the conversation we have in the States all the time, certainly in continental Europe as well. It's a crucial one we're going to continue to monitor as well. We also have one eye on the oil prices as well, because even though risk sentiment is a little sour across the board in the equity market, I'd even throw in the bond market as well, oil is singing a different tune this morning. Brent crude trading at a 64 handle, NYMEX at 62. That geopolitical risk premium has narrowed. We're looking at about a less than $2 spread between the two. A lot of this has to do with the trade story. It's really mostly OPEC plus here. A hike over the weekend, but not as big of a hike as expected. We're going to talk about the next steps, especially in the context of what's going on in Ukraine and Russia. Stick with us. This is Bloomberg. This is the opening trade. We're about 30 minutes into today's session, seeing risk sentiment sour across the board. And I think it's interesting, especially seeing it in the DAX and the CAC 40 as well. Now, this is crucial here because that underperformance that we're seeing in the context of the geopolitical tensions and certainly the latest attacks both in Kyiv and in Moscow, the DAX is one of your underperformers. The CAC 40 taking a bigger hit. Perhaps that's a trade story in the background as well, Lizzy.
Yeah, and if we look to the defence picture, so you've got outperformance for Rheinmetall at 1.9%, Saab up 2.2%, similar moves for Leonardo, but underperformance perhaps for BAE Systems. And this is interesting given that today is the day of the UK Strategic Defence Review, and there's still this question over whether the UK is spending enough on defence. We've been hearing from the UK Prime Minister Keir Starmer this morning declining to commit to that 3% defence goal until funding is clear. So basically, after Trump came in, of course, we had Starmer promising to raise defence spending to 2.5% of GDP by 2027. The US, of course, wants 5%. They floated this 3% target, but they're not guaranteeing that money at the moment because, of course, we know that the UK is so fiscally squeezed. The Defence Secretary admitted that he's still trying to stop a net fall in the size of the army. So when you look at BAE Systems, maybe this is a bit of nervousness about whether the money is going to come through to spend on UK defence stocks and whether actually all of that money is going to be going just to UK companies or to US companies as well.
Absolutely. I think Sharon Bell, among others, had said that some of the 70 or 80% of the European defence spending ultimately leaks back to the United States because of those key players. That's going to be something we watch, especially given the conflict and the latest headlines over the weekend. The conflict between Ukraine and Russia ratcheting up just as the two sides were set for a second round of talks in Turkey. And Ukrainian drones hit Russian airfields as far as eastern Siberia on Sunday, while Moscow launched one of its longest missile and drone attacks against Kyiv. And Ukraine's neighbor Poland as well at the same time has elected a Donald Trump-backed nationalist as its next president. These are all interrelated stories in three different geographies. Oliver Crook, our European correspondent, is all over. He joins us from the Polish capital in Warsaw. Ollie, before we dive into the Polish elections first, I know you've been covering the story out of Ukraine very, very closely. Just walk us through these rise in tensions and why these long-range attacks are such a big deal.
Yeah, and of course the attacks over the weekend will be closely followed by everybody in Poland who's been one of the staunchest sort of advocates and supporters of Ukraine. And seeing what we saw over the weekend, this sort of very sort of ingenious, spectacular sort of covert operation by the Ukrainians, taking out, if you believe President Zelensky, about a third of the Russian capacity in terms of cruise missile delivery across the country, all happening as you have simultaneously, allegedly, conversations happening in Turkey about getting towards a ceasefire. The second person-on-person contact from the delegations, from the Ukrainians and the Russians meeting in person again in Istanbul. Remember, the first time that we had those talks, they were at the behest of President Donald Trump, who was really trying to push both sides to the negotiating table. The only thing that was really worked out was a prisoner swap. We expect more discussions along those lines, more discussions about possible prisoner swaps between the Russians and the Ukrainians, but potentially getting still some distance away from the sort of holy grail here, which is a full unconditional ceasefire. The Russians have shown basically no inclination to move forward with that. They seem to be gaining initiative on the battlefield. And again, we should say that despite the fact that you have these conversations and that the Trump administration really is pushing the ceasefire, we are seeing from both sides, the Ukrainians, some of the boldest military action within Russian borders, and for the Russians on their part, some of the most intense bombings that we've seen over the last couple of weeks in Ukraine since the very beginning of the war. How do you interpret that? Could it be that everybody is trying to get into a better negotiating position and we may be closer to discussions on a ceasefire? Or is this just more evidence that this war is going to continue to be bloody and is anywhere near conclusion?
So, Ollie, factor in the story from where you are. You're in Warsaw covering the Polish election. It's been a loss for the pro-EU, pro-Kyiv candidate. Where does that leave the future of Ukraine? Where does it leave the story for the European Union?
Yeah, we should say that in Poland, unlike many of the other European countries where you have far-right, right-wing candidates, they are still very supportive, even the Law and Justice Party of Ukraine. They're very, very skeptical of the Russians. That is due in large part to the long history for Poland being attacked by the Russians and the Germans, and they're very sort of sensitive to anything like that. So you're not going to see anything like rapprochement to the Russian side. That being said, the president candidate that won, Karol Nawrocki, says that basically there is a red line. They do not want the Ukrainians to join NATO. That was one of the sort of great distinctions between these two candidates as far as Ukraine is concerned. And as far as the Europeans are concerned, they're currently embattled, yes, with support supporting Ukraine against Russia, but they're basically now a trade war with the United States. What they would have liked to have seen in Brussels here in Poland is a candidate that shows more European solidarity, that does not undermine the position. And what you have today, very, very narrowly, is a candidate that is much more Eurosceptical, much more anti-EU, not advocating anything like the AfD, like withdrawing from the European Union, but basically wanting to take a lot more sovereignty from the Poles. That is not a strong negotiation position from the Europeans, who really would like to give a united front to the Trump administration. A Trump administration, we should say, who did back this right-wing candidate here in Poland, which again will help sort of undermine the European position on a number of issues, but especially in these trade negotiations.
Well, Ali, just walk us through what the mood on the ground is, because, I mean, as we were watching, the first round elections and, of course, the developments over the weekend, this was a very tight race. What does it feel like to be in Warsaw right now?
Yeah, it was an extremely tight race. I mean, we were at the square here yesterday. This is the presidential palace. This is where the president will inhabit for his next term within Poland. There was, a small demonstration. Everything was really quite peaceful. We saw at one point a big poster being rolled out for the centrist candidate, because, of course, in that first early election poll, he was sort of slated to win by, a couple of basis points. That reversed overnight, and that is what you had this morning with this sort of turnaround. So this is an election that was won by less than 1 full percentage point. So, again, coming down to the wire. And for Donald Tusk, who's running on a very ambitious reform agenda, he was elected in 2023 after 8 years of law and justice, right-wing politics. He basically will be frustrated now for the rest of his term, because the president here has a great deal of veto authority, has a lot of authority also over the central bank appointment. They choose who is in the central bank. And there's been a lot of discussion, a lot of disagreement, we should say, between the finance ministry and the central bank. The finance ministry has accused the central bank basically as pulling for the other team politically. And these are the kinds of tensions that you're going to continue to see here in Poland in the next months and years.
OK, Bloomberg's Oliver Crook out of Warsaw. We thank you. Headaches for Tusk ahead, but good news for the MAGA movement, perhaps, after all of those losses in Canada, Australia, Romania. Does this embolden the likes of Viktor Orban in Hungary? A lot to keep an eye on there in Poland, not to mention the market impact. But we also need to factor in what's happening in the oil market. We were discussing what's been happening in Ukraine over the weekend, and the geopolitical and trade risks ramping up and factoring into the oil story as well. OPEC Plus as well, hiking production by less than some had feared. Let's bring all those threads together. We have Bloomberg's Anthony De Paula with us now. Anthony, I wonder what you make of these oil price moves this morning, up despite that production quote increase. Is it that we're focusing on the geopolitics here, or is it because the increase was less than some had feared?
Good morning, Lizzy. Yeah, we are looking at a lot of geopolitical factors in the oil price for sure, but we're also coming back from some pretty weak performances in the past week. So oil has been hurting over the past month or so, and it's really been on the back of that increased OPEC plus production. But the markets have gotten kind of used to that amount of increase. So we're going to be seeing another 400,000 barrels a day coming out of the group as they roll back those production cuts. Some people had expected, and there were reports going into the weekend, that OPEC Plus might try to increase even more than that 400,000 barrels, and that would have weighed on markets coming into today. So the fact that they didn't do that, the fact that they stuck to expectations was a little bit reassuring for the market. But remember, OPEC Plus had originally wanted to increase production by about 100,000 barrels a day as they rolled back these cuts, but they've decided to go in a little bit harder into the market, and that's for the last 3 months where they've made these decisions, that they've decided to go in, instead of that 100,000 barrel a day increase, they're going in by 400,000 barrels a day. So that's a lot more oil coming on the market as they try to get back some market share, as they see also geopolitically the Trump calls for lower prices. So it seems like they're taking kind of that view. The prices are going to be a little bit lower for a little bit longer. Let's get some market share back. Let's take some share from, say, U.S. shale producers, some producers in Brazil, some of those other non-OPEC countries that have taken back this market share. So that's what we're seeing in the market as they do kind of get back in a period where there is still that pre-summer demand that is propping up prices as well.
Well, Anthony, you talk a little bit about kind of the factors that create a floor when it comes to oil. Let's talk about the factors that create a ceiling when it comes to oil price. That, of course, is that tariff uncertainty. Very quickly, if you can, talk to us about just how much that tariff uncertainty is priced in to the oil market.
Yeah, well, that's been having oil prices bounce around pretty much since January, and then we did see them take a leg lower as OPEC began ratcheting up their production. So I think that what the issue is going forward is going to be, this uncertainty continuing to weigh on prices. But as we get beyond the summer, we're also going to see weaker demand as well, too. So that's going to be an impact. And that's why we're seeing lower oil price forecasts for the second half. So it's a little bit more of a bearish outlook. We don't see stockpiles building now, which is what OPEC sees giving them the freedom to do these increases, but that should start weighing on the market as demand starts to weaken towards the second half, according to the forecast that we're seeing, and that's why we're seeing some lower price forecasts, Kriti.
Anthony DiPaolo in Dubai walking us through the push and pull, the range that we're seeing oil trade in. We thank you so much for walking us through that crucial piece. He made a key point there that you are starting to see this bearishness in the oil price, but that is actually positive news for the Trump administration, or at least touted as it shows up at the pump in the U.S. And also good news, perhaps, for the airline industry. Coming up on the program, we're live at the IATA World Air Transport Summit in New Delhi. If you're wondering where Guy Johnson is, that's where he will be reporting from today. Shortly, we'll be joined by the Air France KLM CEO, Ben Smith. But as we head to the break, I just want to leave you with a little bit of sound. IATA's Director General speaking to Guy earlier.
Well, when I look at things, I think some of these events that we're seeing at the moment are short-term in nature. And therefore, they're not going to have a long-term impact on the growth of the industry. What I believe is that the demand for aviation, demand for flying remains strong, and that will continue.
Let's take you to one of our top interviews now. The US airline Delta says that it's expecting travel demand to recover in the second half of the year. That's after price-sensitive passengers in the US pulled back on spending as the economic climate worsened. The CEO, Ed Bastian, spoke to us exclusively at IATA's AGM.
Year over year, though, demand hasn't fallen. Demand's pretty flat, and I expect in the second half of the year, it hopefully will tick up a bit.
In terms of being more specific about where we are seeing the uncertainty manifesting itself the most, is it businesses? Is it consumers? Is it front of the plane, back of the plane? Yeah. Is it company CEOs saying, actually, I don't know, I'm going to sit still, I'm going to wait and see what happens next, so therefore I'm not going to travel as much?
It's predominantly in the U.S. marketplace, predominantly in the main cabin section of the plane amongst our most price-sensitive customers. Business traffic is holding up. It hasn't fallen. It's again hasn't grown as much as we hoped. But this time of economic uncertainty is a little bit different than a recession. In a recession, you'd have businesses pulling back on cost and pulling back on travel and making some short-term tactical decisions. When you have the nature of the uncertainty we have, which is a little bit more geopolitical in nature, businesses have to be traveling. They have to be out with their customers. They have to be out seeing what's happening in the marketplace. So businesses are still traveling.
Does that apply to the North Atlantic?
Yes, absolutely.
What are you seeing at the moment on the North Atlantic?
North Atlantic is doing well. The main cabin of our coach cabin, there's a little more price sensitivity in that section, but on the front end of the cabin, those yields are strong and the demand is strong.
Is the dollar having an impact? Weaker dollar? Yeah. Are Americans traveling less, I guess is the question I'm really asking.
No, we haven't seen that. We're about 80% of our point of sale is U.S. going across the North Atlantic, and that's holding in there.
We're sitting here in India. You've just announced a partnership with Indigo, the huge low-cost carrier run by Peter Elbers here. Is there an opportunity that you now have to maybe diversify? The markets that have done well historically, recently for you, are you looking elsewhere? Are you starting to widen the lens a little bit in terms of where you think the growth will come from? And does Indigo fit into that kind of framework?
Indigo absolutely fits into that framework. And we were talking earlier, this is our centennial year, our first 100 years of flight. And when people ask, what are you going to do in your second 100 years? First thing I tell people is that we're going global. Right now, we're about 2/3 domestic, 1/3 international. I would hope over the next coming decades that we at least level it out and maybe even flip it to more international opportunities than domestic. Because you see countries like India that are growing significantly with great airlines like Indigo that's going to become a partner of Delta's. And when you think about what we can do in terms of bringing growth to the future, it's great.
The Delta Airlines CEO Ed Bastian there speaking exclusively to our very own Guy Johnson. And Guy, of course, joins us now in case you were missing him from New Delhi. He's, of course, at the IATA World Air Transport Summit. Guy, we were just listening to your conversation with Ed Bastian. Who do you have for us now?
Well, we've actually got one of Ed's partners, Ben Smith, the group's CEO over at Air France KLM. Actually, Shai Weiss is waiting in the wings as well, another part of that alliance as well. But Ben, it's great to see you.
Oh, great
Always
to see you too. Yeah.
Thanks for the time. Look, you updated us recently on what was happening in the demand story. Any change since then? What's happening?
No, things are steady, as we've been saying publicly for quite a while now, and we're reassured that our premium demand is holding across all of our sectors, and in particular the transatlantic, the North Transatlantic, and we're seeing premium hold and economy. The demand's there, but we've had to lower yields to fill the airplanes. But the fuel prices come down.
Is fuel compensated?
Yeah, it's a good balance.
So do you think fuel's sort of down here for a while?
Look, I wish I were an expert at predicting. We're hopeful, but all indications are it's not moving. But if
demand continues to soften, you're going to be able to use that fuel lever to maybe lower fares, stimulate a bit of demand. Is that going to be what the strategy looks like?
Well, I think we're on a very clear trajectory for our group. We were not in a good position in 2018. We lived through COVID, and we've restarted the same strategy that we had before COVID, and it's working. Like Air France in 2023 had its best year financially in the history of the company. 2024 we had the Olympics, which kind of was an anomaly year, and then this year looking good so far. We have the U.S. that wasn't predicted, but as I said, demand is still strong in premium, and we're a premium airline.
So, but the back of the plane is, so there's no update. The back of the plane is kind of as it was, i.e. there's some signs of weakness in that space.
Yeah, we're seeing 2-3% softness, and we have to stimulate with lower pricing.
In terms of the U.S. market, are you seeing? Is the stronger dollar? Is the weaker dollar, stronger euro, putting off maybe some U.S. travellers coming into Europe? Is that a factor that we need to think about through the summer?
Well, look, France is still very popular for Americans. We're seeing that. We're hearing that. Is the dollar making a difference in the attractiveness of France or Europe? Yet to be seen. The Netherlands, it's not the same size of the market of France. Pretty steady. But Paris it's amazing, and the volume is good, but the premium is strong. And if you just not only the airline sector, but if you look at the rest of the hospitality industry with hotels, with the gourmet Michelin-starred restaurants, they're doing well as well.
There is some evidence talking. If you talk to the hotel groups, they say though that there is some evidence that Europeans are being more cautious in terms of travelling to North America. Any evidence of that?
As I said, premium is holding, which is most important for us. We are disproportionately premium, at least at our Air France subsidiary, and we're becoming more premium with the size of the cabins getting larger relative to the size of the airplane, so we're more exposed. And if you look at Air France KLM versus our two main competitors in Europe, we're less exposed to the transatlantic. We've got 25% of our capacities on the North Atlantic, where the other two are much, much higher.
How important will it be to your group that we see an EU-US trade deal?
That, of course, would be positive. How important it is, I think we need stability on knowing the impact of potential, price changes to how it could affect airplanes, engines, and supply chain.
What are you hearing? The talk around here is that we're going to be seeing price rises. That ultimately we're already starting to see them. There's a 10% tariff kind of that's already on. That is starting to feed. Are you starting to kind of witness that? Is there evidence of price pressure coming through in the supply chain?
Yeah.
Like it could be spare parts, it could be new engines, it could be, I'm not sure where it's going to be.
Yeah, spare parts, we're starting to hear, see, get notices that there are increases. Engines a bit early, and the bulk of our orders, like the vast majority of our new airplane orders are with Airbus.
Yep.
So that's not a subject as of today.
Right. But, and would you be concerned, say the tariff level, like at the moment it's 10%, there's a baseline 10%.
Yeah.
We're coming up on some key dates. So, like, what's the difference between 10% and 20%? Like, obviously, there's a kind of mathematical figure there, but in terms of just the message it sends about the relationship, the interrelationship between European business and US business, like, how important would that be? Would you see a drop-off in business travel? Are you already seeing a drop-off in business travel? Is there an uncertainty that is beginning to manifest itself there?
Yeah. Well, when I said premium, I lump in business traffic.
Right, okay.
So it's all traffic in business class or La Première, premium economy. So I said that's holding. And what we see going forward is also holding. So any risk or, I guess, uncertainty around the impact of tariffs, where a lot of businesses are worried. Of course, we look at it every single day. As I said, the most important traffic for us is holding, and we're very happy about that, and we're quite relieved. Now, things could change, but as of today, premium is good.
Just give me a quick sense of where you are with M&A. Like the TAP post-election, we're all wondering what happens next. I was speaking to Luis a few minutes ago at IAG, get his take on it. What's your kind of view on what's happening here?
Well, number one for us is moving forward to a majority stake position in SAS.
Yep.
So we have 19% today, and we have the exclusive right to go to majority. So that's in the works. It's just a question of timing when we'll do that. And then on the Iberian Peninsula, the TAP sale with the constant, the uncertainty with the government, what the government is looking for, under what conditions is still unknown to us. And once that's made clear, we'll make a decision whether we can fit those requirements and whether it's of interest to us. In Spain with Air Europa, we've been in extensive negotiations with Air Europa. We're not anywhere near an agreement, so I have nothing to tell you today.
Okay.
But the Iberian Peninsula is an important market for us. But Latin America is key, and if we can find something that works on the Iberian Peninsula and it's positive, for sure. If it's too much risk or it's too expensive, then no, we'll do what it takes to maintain our position in another way.
Sounds quite straightforward. Ben, it's great to catch up. Thank you very much indeed for dropping by to see us. We really appreciate it.
Okay, thanks, Guy.
Ben Smith, CEO of Air France KLM. Kriti, back to you in the studio.
All right, Guy Johnson there reporting from New Delhi, talking to us a little bit about the M&A picture in the airline space, but also, of course, the consumer as well. Lizzy, we're going to get plenty of those checks in terms of those geopolitical pieces that are driving this market narrative. Guy was talking there about the consumer. I'm going to talk about financing conditions later in the week at Super Return, but there's plenty of other data points to keep our eye on this week.
Yeah, we've got US ISM manufacturing numbers today. We've got the Chinese Kaixin manufacturing PMI tomorrow. Wednesday, we have rate decisions out of Poland and Canada. Thursday, we have Friedrich Merz, the German Chancellor, meeting Donald Trump, of course, and we also have that ECB rate decision on Thursday, and of course on Friday it's also US jobs day. It's a plenty busy week, and you've got Super Return, as you say.
And I've got Super Return. We're going to talk about the private markets. We've got some really great exclusive conversations coming up on this program. That does it for the opening trade today. Pulse is up next. Stick with us. This is Bloomberg.